Thank you for joining us again on Wealth Plan TV. Today we're dealing with accumulation and we're joined today by Serge Giampetroni from SGI Consulting Group. Serge, thank you for joining us.
Thank you.
You're going to help us tease out the mysteries of what accumulation actually is in the GoDare concept. Can you tell us what you think accumulation is?
Certainly. Accumulation in many ways is just an all-encompassing term which relies on the building of wealth. Building of wealth can be saving money in your savings account in the bank, could be buying shares over a period of time, could be investing in managed funds. It's basically building up wealth in the various asset classes, if you like to put it this way.
So really any product that allows us to accumulate money, I guess, so that we can live at some point on the money we've accumulated.
Correct. For specific reasons, could be for deposit on a house, much longed holiday, and retirement.
Yeah, or just a swimming pool, or just plain wealth.
Correct.
Yes. That's cool. Now, can we just very briefly go through the things that you've listed as being accumulation products? Can we start firstly, I don't know, with cash? Why would somebody save in cash?
Well, cash tends to be the most understood investment that we have. We're born with the concept of always putting money in a piggy bank, which will then end up in a bank, and we always go with the concept of, well, everything is safe as long as it's in cash. So that's the first investment that we are introduced to very much in our life.
Okay. How does that fail? If it was so good, why don't we put all our money in cash?
Because cash is very restrictive. It doesn't grow. What you put in, you'll get a certain rate of return. And it's the very, if you want to call it, security or comfort of knowing that nothing's going to happen to it, that actually is a detriment to that type of investment.
Okay, we'll come back to this growth income concept shortly. Could we go through to what a bond is and how does that work?
Okay, bonds are very much what we'd refer to as a debt mechanism. So if you're talking about a government bond, it's actually the government going out to the marketplace and saying we need to borrow $1 billion or $2 billion. So we are offering these bonds at this particular rate. So, and obviously if it's a government bond, there's a much higher level of security. If big companies such as BHP, Rio, Seven Network will go out and try and raise capital and they'll issue bonds. And obviously they won't be as secure as what a government bond will be.
And what's a junk bond rated as?
Junk bonds are pretty much right down the scale, and depends on
D's and C's. Yeah.
Yes, D's and C's, and depends on which agency you're using to rate them.
Yeah.
But they are very risky bonds, whereby it's a small company or probably a very small resources company trying to raise money, and you're taking a very high risk. But for that risk, there's supposed to be a reward, which is a greater rate of return.
Okay. Shares. Well, tell us a little bit about shares, if you would, Serge.
Shares are often a misunderstood concept. Shares are really a representation of a particular company on a stock exchange, and each share is valued based on what the market, being the general population out there, including the fund managers, will value that company to be at. So if you've got a company that's valued at $1 million, 1 million shares, well, each one of the shares is a dollar.
Okay. I often had clients come in and say they didn't like shares, they preferred property because they could see it. But I'd often explain to them that if they owned some Commonwealth Bank shares, they could go into their local branch, stand on a square metre and floor, and it was probably theirs.
And this is my comment before, which is they are very much a misunderstood asset. And I use an analogy very often with people, saying if you have an investor that's invested $500,000 on a property, and you have another investor investing $500,000 in shares, share market and property market take a 30% correction. The gentleman of the property market will say, well, okay, my property's only worth $350,000. It's an investment property. I'm getting a rental return. I'm comfortable with it. Long-term investment. 5 years or 6 years' time, we'll be back up there, but in the meantime, I'm getting my rent. Now, the share investor, in most cases, will just look at his portfolio value at the end of the night and say, I've lost $150,000. Doesn't think about the fact that if they bought into blue chip shares in 4 and 5 years' time, same length as a property, they'll most likely be back up to their current value. In the meantime, they're also getting dividends. And those dividends, in most cases, carry a far better tax treatment than the rent you pay, that you receive from a rental property.
And you don't have to cut the grass.
That's right.
Yeah. We've got a nice segue into property. Serge, can you tell us a little bit about property?
Yes, property is the second most understood asset after cash. Again, it's the first thing that we buy to live in. It's the first thing that we move into, whether we rent it or buy it. And it's also been the asset, the preferred asset from our parents to build their wealth with, to accumulate their wealth for the longer term. And property comes in many forms. You can have your direct property, buying the house down the street, or buying the factory down the street, or you can have it as part of a managed fund.
Okay, can you stop there, because you've introduced a concept which is really valuable. So we're talking about direct and indirect ownership.
Correct.
Can we just cover that in relation to probably all of the asset classes we've discussed so far?
Yes, you have a number of options when you are investing, and like you quite rightly put it, direct and indirect. Direct means you're going to the market and you are purchasing that particular investment. So if we're talking about property, you will be buying that property down the road, that shop down the road. If you're buying shares, you'll be going on a stock exchange through a broker, and you will be buying, say, CBA or ANZ. So you'll be buying your shares directly. And then it's up to you to manage it.
Yep.
Okay? Whereby if you're going to indirectly, you are actually then retaining someone to actually do it for you.
Okay.
And this is where a managed fund comes into play.
So the managed fund is the manager who manages the asset class on your behalf?
Correct.
Okay, that's
Correct.
cool. Right, so we've got some nice concepts here that we want to follow. I think I might like to come back to a managed fund, but before we do that, we touched on what an income and a growth investment was. We touched that in the definitions of those classes of investment. Can you tell us what's the difference between an income investment and a growth investment?
Okay, traditionally, an income investment is one that will give you a yield. And let's use term deposits. They're a classic example. Put $100,000 into a 3-month 5% term deposit. Well, that's what you will get at the end of that 3 months, 5% on your money.
And the money wouldn't have grown, you get the same
Correct.
back.
Yeah, so 100 in, 100 out,
Yep.
plus 5% yield.
So that's why it's called an income investment,
Correct.
because that's all you get.
Yes.
That's
And
cool.
traditionally that will encompass your bonds that we spoke before,
Yep.
and your cash in the bank.
Okay, bonds are a bit trickier than that, but we won't
Oh,
cover that
certainly,
now.
yes.
All right. Growth investments. Can you tell us what growth investments are?
Growth investments are investments that can provide you a combination of income. Shares will give you dividends, property will give you rent, and then the growth component is the actual increasing in value of that asset. You bought a house down the road for $300,000. In 5 years' time, it may be worth $500,000.
I hope everyone thinks that's true.
Yes.
They don't realise that property also goes backwards like every other
yes.
growth asset.
And
Yeah.
pretty much it's pretty much a case in point at the moment.
Yeah, absolutely.
You know.
Okay, so you're saying then an income investment, you invest a sum of money and that sum of money never grows.
Correct.
And a growth investment, you invest a sum of money, get an income, and that money continues to grow.
Well, that's what you would
Or
like
shrink.
it.
Or shrink.
Yes.
And that's why I guess that people don't always use growth assets maybe the way they should, because there's a fear element there.
Correct.
Thank you very much, Serge. I'm sure our viewers will enjoy your knowledge. We'll cut to a break and we'll see you again to learn more about accumulation.